Hi everybody, welcome to Chapter 17. We discuss pension benefits and other post-retirement benefits in this chapter. Accounting for pension benefits recognizes that they represent deferred compensation for current services. Accordingly, the cost of these benefits is recognized on an accrual basis during the years that the employees earn the benefits. United States pension funds total more than $15 trillion. Periodic pension contributions constitute one of the largest expenses many companies report. The corporate liability for providing pension benefits is huge. Obviously, then, the financial reporting responsibility for pensions has important social and economic implications. Pension plans are designed to provide income to individuals during their retirement years. This is accomplished by setting aside funds during an employee's working years so that at retirement the accumulated funds, plus earnings from investing those funds, are available to replace wages. Corporations establish pension plans for a variety of reasons. Sponsorship of pension plans provides employees with a degree of retirement security and fulfills a moral obligation perhaps felt by many employers. This security can also induce a degree of job satisfaction and perhaps loyalty that might enhance productivity and reduce employee turnover. Motivation to sponsor a plan sometimes comes from union demands and often relates to being competitive in the labor market. Sometimes employers agree to annually contribute a specific or defined amount to a pension fund on behalf of employees, but make no commitment regarding the amount of benefits available to employees at retirement. In other arrangements, employers don't specify the amount of annual contributions, but do promise to provide determinable, defined amounts at retirement. These two arrangements describe defined contribution pension plans and defined benefit pension plans, respectively. A defined contribution pension plan promises fixed annual contributions to a pension fund, sometimes 5% of employees' pay, or more often the employers promise to match employees' contributions to the plan. Employees choose from designated options where funds are invested, usually stocks or fixed income securities. Retirement pay depends on the size of the fund at retirement. Defined benefit pension plans promise fixed retirement benefits defined by a designated formula. Typically, the pension formula bases retirement pay on the employee's A, years of service, B, annual compensation, often measured by the final year of pay or an average of the last few years of salary, and sometimes it depends on the employee's age. Employers are responsible for ensuring that sufficient funds are available to provide the promised benefits. Today, approximately 75% of workers who are covered by pension plans are covered by defined contribution plans, and roughly only about 25% are covered by defined benefit plans. This represents a radical shift from previous years when traditional defined benefit plan was far more common. In fact, many companies are terminating long-standing defined benefit plans and substituting defined contribution plans. This shift is due to three main reasons. First, Government regulations make defined benefit plans cumbersome and costly to administer. Second, employers are increasingly unwilling to bear the risk of defined benefit plans. With defined contribution plans, the company's obligation ends when contributions are made. And third, there has been a shift among many employers from trying to buy long-term loyalty with defined benefit plans to trying to attract new talent with more mobile defined contribution plans. Both types of plans have a common goal: to provide income to employees during their retirement years. Still, the two types of plans differ regarding who bears the risk for whether the retirement objectives are achieved. Does the employer or the employee bear the risk? The two types of plans also have entirely different implications for accounting and financial reporting. Our discussion of defined contribution plans will be brief. Although these are now the most popular types of corporate pension plans, their relative simplicity permits a rather straightforward accounting treatment that requires little explanation. On the other hand, defined benefit plans require considerably more complex accounting treatment and constitute the primary focus of this chapter. Defined contribution plans promise fixed, periodic contributions to a pension fund. Retirement income depends on the size of the fund at retirement. No further commitment is made by the employer regarding the benefit amounts at retirement. These plans have several variations. In money purchase plans, employers contribute a fixed percentage of employees' salaries. Thrift plans, savings plans, and 401k plans permit voluntary contributions by employees. These contributions typically are matched to a specific extent by employers. Many employers match up to 50% of employee contributions up to the first 5 or 6% of salary. When plans link the amount of contributions to company performance, labels include profit-sharing plans, incentive savings plans, 401k profit-sharing plans, and similar titles. When employees make contributions to the plan in addition to employer contributions, it's called a contributory plan. Accounting for defined contribution plans is quite easy. Each year, the employer simply records pension expense equal to the amount of the annual contribution. Suppose a plan promises an annual contribution equal to 3% of an employee's salary. If an employee's salary is $110,000 in a particular year, the employer would simply recognize pension expense in the amount of $3,300 contribution required. Here we debit the pension expense with $3,300, calculated as the annual salary times 3%. Then we credit cash with the same amount as the contribution is paid. Well, that's all for this video. In the next video, we'll begin our discussion on accounting for defined benefit pension plans.